Good day, friends. Welcome to my next video cast. I thought today I will take the opportunity to talk about the AMFI flows, which got published today. I'm sure you have seen a lot of the data on various websites as well as the news channels, and they seem to convey. So I just thought I would give my inputs to those, because I think the media tends to compare last month's flows to this month's flows when actually that difference doesn't matter. So, for example, last month they said 38,000 crores was the inflow into equity. This dropped to 34, and though the market is up, it's dropped. So it's conveying a kind of a negative feeling as if flows have dropped. The point is that if these are all net inflows into the industry, right? So whether it's 38 or 34, you got to take it as a net inflow, which is money which has come from outside the equity system of the mutual funds into the system. So let's look at it first. Prima facie, it's saying there's at least 34,000 crores of fresh money available to mutual fund managers to deploy. Now, even that number is disputable. It's just a headline number which they have thrown. So if you then look at it, right, there's equity, there's hybrid, and there's debt, and within debt there's short-term debt, which is money market funds and liquid funds, and there's medium-term debt. So it's the total picture that we need to look at, and there one of the things which is a good thing to do is to ignore the short-term debt funds, which is the liquid funds, because these are largely corporate surpluses which are deployed. And as you know, September end, quarter end, they tend to take it out and put it in bank deposits and not want to show mutual fund investments, and so that's not very relevant. So my focus is largely on the equities market, but then I think it's also important to look at the debt, because ultimately my focus is where are investors and distributors advising people to put money, what is the total amount of that money that came into the market, and then to say that how has that portion been split, right? So this is the next level analysis that I want to present to you, right? Now I wanted this to be a very short video, but I've already spent 2 minutes in the run up to the video. So the first time that I'm doing this update will take a little bit longer. From next month onwards, I'll target to do this within 2 to 3 minutes, right? So then what's my analysis at this point? So and as I said, I would rather tend to ignore the institutional flows, because they are done by very experienced fund managers who take quick calls between equity, debt, arbitrage, and all that. So if you generally ignore what I look at the corporate segment of liquid funds and all of that, 54,000 crores of money from retail plus HNIs has come into the equity plus debt market. Now that's a huge amount of money, and that's when we tend to compare with FIIs, people tend to use $1 billion just to frighten people, right? Oh, this much $1 billion FIIs withdraw, this much they're bringing in. So this 54,000 crores amounts to $6.5 billion. So the strength of our domestic investor base should not be forgotten, right? So this September month alone, fresh money has come into the mutual fund sphere from individuals, both retail and HNI, of $6.5 billion. Now, where has this $6.5 billion gone? Of this $6.5 billion, $5 billion has come to equities, right? And the balance has come to debt in various forms, right? Why do I say various forms? There's money which comes into long duration funds, gilt funds, direct lend funds, and then there's a portion of hybrid equity funds, which also has about, let's say, 30% on an average allocation to debt, right? So out of this 54,000 crores, 42,000 crores, which is $5 billion, has come into pure equities, right? So that's the power now we have. Now, why do I stress on this? Because as we all know, you heard news about yen carry trade a couple of months ago. You talked about geopoliticals. You talked about China suddenly giving stimulus and FIIs going away. So FII, one portion of the FII money, which is the hedge funds, tends to be volatile, and they look at India as a stock. So based on India's valuations, outlook, they either pull money into India or put money in very short-term phenomenon, whereas the long-term FII money from sovereign wealth funds or active mutual funds, that tends to stay for longer, because that's based on a fundamental analysis of the growth prospects and the valuations, right? So our market, my purpose in the analysis today is to tell you that when the FIIs take a negative view on India because there's a positive view on another country, They're taking a negative view on the market of India. They're not taking a negative view on India. But at the same time, as distributors, as investors, when you're allocating money, this creates volatility in your own portfolio, right? And so, given that we are in a period where there's a US presidential election up, there's geopolitical tension up, and as you know, the China factor keeps coming up, there is likely to be volatility from FII flows from the hedge fund component. How well are mutual fund managers, right? I'm leaving aside insurance managers and PMS and AIF. That's a black box because we don't know what kind of money they deploy. Able to counter the volatility of the FII and give comfort to us that how much the volatility I should be prepared for the market, right? So in my analysis, this 42,000 crores, now you can say that, oh, that 42,000 crores, 5 billion means if FII sell 5 billion, I can protect our market to the extent of 5 billion. No. Why? Because as we know, domestic investors and distributors advise their customers across the range across the cap curve. There's large caps, there's mid caps, there's small caps. Whereas FIs and notably hedge funds, because they're taking very short-term calls, are largely in the large cap oriented. So not all of this $5 billion worth, which is 42,000 crores worth of money with mutual fund managers, is available to defend against that corporate raider, that hedge fund, right? So how much is that? So I did some drill down analysis, right? And I took large cap funds out of this 42,000 crores. I took index funds, passives, index funds and ETFs are largely in the large cap space. Then I took the flexi cap and the large and mid cap and multi cap, where you can say the significant portion gets allocated large cap. Now this is the money which will essentially help us to defend, right? How much is that component? And I have also taken within the hybrids, because by and large in hybrids, which is balanced advantage fund, aggressive hybrid, equity savings and those kind of funds, multi-assets, fund managers tend to buy more large caps because those hybrid funds are meant to protect you from volatility, right? So I've assumed that there's a 70% which goes into equities and hybrid, and of that 70%, another 70% goes into large cap oriented, right? So if I then create this pool, out of this $5 billion, 2.2 billion, that's 45% of this, is FII defendable money, if I may put that new terminology in it. That's the money with which domestic fund managers can fight the volatility caused by short-term FIIs. So what I'm trying to say is there's 18,500 crores of fresh money that has come into the mutual fund industry last month, which will enable these fund managers to defend against the selling by hedge funds. So that's the level of protection you will get. And the balance, whatever, right, that's another 2.8 billion, which is 55%, will generally be spread across mid cap and small caps, right? So from a portfolio allocation point of view, right, this also tells you what distributors are doing. Distributors are very rightly reallocating the money. Almost 45% of the money is coming into a defendable space against this. And as you all know, investors want to invest in mid cap and small cap. That flows have been consistent because they have seen the past returns. And many distributors also look at those past returns and say, why not I use this? But the important thing is that a lot of experts have been advising people to actually reallocate the portfolio to large caps, right? Because why? Because mid and small caps have run up a lot. So probably in the coming months, large caps will play catch up. So that reallocation has been happening, as you would have seen from various media interviews by industry experts. So it's good to note that distributors are also allocating it accordingly, which means overall 45% of the flows are in a large cap oriented space, whichever form it may come in. So that's the good news. So from here to then take a call saying what is this going to mean for the immediate month? It means for this month of October, fund managers have got 18,000 crores worth of money which you can use to buy large caps when FIIs sell, or if FIIs sell, and protect your portfolio, right? But at the same time, it's only 18,000 crores. Remember, FIIs can sell little more than that. $2 billion is nothing for FIIs in a month's time, right? So expect that this will help fund managers to limit volatility in your portfolio, but not completely protect it. At the same time, the fear around mid and small caps should also come down because there is so much money available for fund managers to invest. Thank you very, very much with that.